You've got to remember this. Like, this is the reason why free cash flow is the lifeblood of every investment. Focus on the free cash flow. One of the most important metrics for any company is free cash flow. Mo, what is free cash flow?
The lifeblood of a company.
Right, but how do you calculate it?
Cash from operations less your capital expenditures.
Correct. So let's pull up a company like Microsoft. It's a very high cash business. They generate a ton of cash. We go to the cash flow statement. We scroll right here, and in our software, we make life so easy for you. We actually added this line to show you free cash flow. Cash from operations less your capital expenditures. Now, why do we look at free cash flow so much? Well, guys, these capital expenditures are depreciated on the income statement. So when you buy a building for $1 billion, you cannot deduct that $1 billion off your net income because the government's going to say, wait a second, you invested in a fixed asset, you can only deduct it over a long period of time. But it definitely affects your free cash flow. It has affected how much money is in. If you generate $10 billion in operations and you spend $10 billion in capital expenditures, your net income will look a lot higher because you can't deduct that $10 billion in capital expenditures day one. So free cash flow is the money that's actually left for you at the end of the day to be able to do one of 5 things. Mo, let me try to quiz you here. What are the 5 things?
Pay dividends.
Yep.
Invest in yourself.
Yep.
Buy back shares.
Yep.
Pay down debt.
Make acquisitions.
Make acquisitions.
Invest in yourself. So make acquisitions is the 5th one.
There we go.
Companies can take that free cash flow and do any combination of those 5, do whatever they want to do with it. They can actually just stack it in their bank account too.
Yeah.
Do whatever they want to do with it. But that's the lifeblood of the business. And what you want to do is you want to find companies that are able to generate good free cash flow and not have such a big percentage of their cash from operations be capital expenditures.
And it's hard to go broke when you have a lot of cash.
It is very, very difficult.
Look at it the same as your family. If you guys have money in the bank and you have a lot of debts and you can pay off all of your debts and still have cash left over, it's very hard for your family to get in a tough situation.
Of course. And software businesses like Microsoft tend to have very, very high free cash flow. Yeah. Let's pull up another company. Let's go to Ford.
Oh boy.
Oh boy,
I don't know what to expect. That's why I'm saying oh boy.
Okay. Well, actually, look at this. Interesting.
Okay. It's not as bad as I thought.
But look how inconsistent it is.
Very inconsistent.
Oh my lordy.
Yeah, it's all over. Some years are in the 20s, some years are in the negatives.
Yeah, but barely in the negative. $13 million, that's like basically break even. Their 5-year average is $9 billion. Okay. So it's not as bad as I thought it was going to be. And I'm surprised because it's a very capital intensive business. Like the automobile business, they need to be always upgrading factories, putting new factories up, all these things that take a lot of capital. Software businesses don't have that issue, right? They don't have to build a new factory in order to make software. They just hire more engineers. Right?
Yeah, I'm looking at Apple's cash flow. Sheesh.
Let's look at Apple's. Let's pull up Apple here.
It's even better than Microsoft's.
Oh yeah, they're spending like 10% of their cash from operations on capital expenditures.
Nothing.
Geez, oh Pete.
5-year average of $81.1 billion.
This is why companies like this are in such hot demand. This is why their PEs tend to be high. Well, the other reason is the 5-year return on invested capital. Right. And this is part of it. Without high capital intensive businesses, you have a really high return on invested capital. It means you don't have to invest a lot to generate more and more earnings. If there's 2 companies exactly the same, and one has to invest $1 billion to increase profit by $1 billion, the other one has to invest $10 billion to increase profit by $1 billion, which one would you rather have?
One that has to invest less.
Exactly. And that's the big key. You want to find companies that don't have to spend as much money to increase that free cash flow because it gives them more free cash flow as time goes on to do those 5 things and create more and more investor value.
Right.
So some of you might be asking this very obvious and good question. All right, great, Paul. So this company generates a ton of cash flow. How do I, as an investor in that stock, see that cash flow? Well, let me do a hypothetical here. Let's say you have 2 companies, Company A and Company B. They both generate $1 billion in cash flow every year. Let's say they're exactly the same company, exact same industry, et cetera. Mo, are you paying any different? Based on this information right now, I'm telling you everything's the same. Are you paying any different price?
Not right now.
Okay. Let's say this one has $10 billion in the bank and no debt, and this one has $1 billion in the bank, no debt. Which one are you paying more for?
The one with $10 billion in the bank.
Right. Okay. So let's say these companies that generate a lot of free cash flow just keep putting it in the bank account. They never take on more debt. They pay off all their debt and they just keep increasing their bank account. That is the point about how you get, eventually, this will generate have so much money in the bank account, $100 billion versus 10. You're going to sit there and say, wait a second, This company has $100 billion. One, it's not going out of business, and eventually you'll find somebody smart enough to go release this value.
Exactly. They're going to buy back shares, which is going to help me. They're going to pay me in dividends, which is going to help me.
They might just issue a $100 billion dividend.
That too.
So let's say there's
special dividend.
Let's say there's 1 billion shares. That's $100 per share in one-time dividend.
You see it all the time. These like Costco, they're notorious for it. They'll do a $10 dividend, one-time special dividend.
Just like that.
Yeah.
So that's how you see the value in the long run. They either pay down debt, or they accumulate a bank account, or they pay it out to you as a distribution. They're like, you know what? We have no use of this money because we generate such a high return on our invested capital that we have so much cash here. Go do something else with it. Yeah. And they're going to pay it out to you. Or they're going to buy back shares. Why is buying back shares great?
Makes your piece of the pie even bigger.
Exactly. So when they take that free cash flow, the more and more free cash flow they have, let's say the company is selling for cheap. Let's say the company makes $10 a share and they have 10 shares. That's $1 per share in profit. If they buy back 2 shares and they still make $10, let's say they make $12 now and they buy back 2 shares, 10 went to 8. Now all of a sudden, your earnings per share went from 1 to 150, even though total profit only went up 20%.
Yep.
Is a company worth more if it makes $1 per share or $1.50 per share?
$1.50 per share.
$1.50 per share. That's what they're doing. That's the key here, guys. You've got to remember this. Like, this is the reason why free cash flow is the lifeblood of every investment. Focus on the free cash flow. Use the net income and free cash flow comparison to kind of tell a story about the company, but focus on free cash flow as a way determining the health and the future potential of the business. If they have high free cash flow with a high return on invested capital, they're going to have a lot more money to distribute to you as an investor and to buy back shares and to do all the great things that make companies great. Let me show an example using a company called NVR.
Okay.
Basically, it's Ryan Homes.
Okay.
So look at NVR. Back in 2000, this is a very popular stock to talk about with value investors. Back in 2000, they did $2.3 billion in revenue and $158 million in profit. And they had 8.85 million shares outstanding. And their stock price back in 2000 was, call it $45 a share. It's currently $5,100 a share, over 100 times more. Now look at them. Their revenue is $10.5 billion, so 4 times more. And their profit is $1.73 billion, so 10 times more. But look at their shares outstanding, 3.2 million. They went from 8.5 million to 3.2 million. They kept buying back shares because the stock was cheap. The market was missing it over and over. And that's how their stock has now skyrocketed to $5,000 per share with a PE of 9.6.
Wow.
Because all I did was the company only grew 4 or 5 times, but it ended up making 100 times for its investors selling at a low PE because the stock was always really cheap. And they just kept buying back more and more and more shares. They decreased the number of shares along with increasing their revenue and profit. That's how companies can really generate. That's how you get the 40, 50, 100 baggers that you can get. Now, am I saying NVR is worth $5,000 a share right now? I don't know, probably not. But look at this return on invested capital.
That's huge.
That's what they're doing. They don't have to invest a lot of money in the business to generate more profit, so they can use that cash to buy back cheap shares and make a lot of return for their investors. 100 times. 120 times in the last, 115 times in the last 23 years. That's the key there, guys. So I want you to learn that. If you like this, subscribe to the channel. If you like our software, $7 for 7 days at everythingmoney.com. Thank you very much.